Good morning, and thank you for joining us for another episode of Chamber Live. I'm Karen Cross, Chief Executive Officer of the Greater Kingston Chamber of Commerce. Selling or buying a business is a complex venture that involves several considerations. That's why we've invited KPMG tax partner Mike Gaylord to share what to consider when buying or selling a business, from the due diligence to selling strategies and tax implications for both sellers and buyers to ensure a successful transaction. I would like to thank KPMG for sponsoring today's session and for their continued support of this series. Now I pass it over to Jessica to say a few words.
Awesome. Thank you, Karen, and good morning, everyone. So my name is Jessica Colvin, Manager, Business Development and Member Services here at the Greater Kingston Chamber of Commerce, and I will also be your moderator today. So kindly note that the session is being recorded and will be available on YouTube later for viewing this afternoon. Please know that we're happy to receive your questions throughout the presentation. I would just ask that you submit your questions in the chat box that you see on the side of your screen. I would also like to thank KPMG for sponsoring today's session. KPMG has been serving businesses in Kingston and Eastern Ontario for over 100 years. With over 40 professionals locally, KPMG's office in Kingston operates as one unit to bring new ideas and opportunities to clients in the private company and public sector space in audit and accounting, risk management, business advisory, and tax. KPMG is managed locally in Kingston, which allows them to make client service decisions quickly. This local strength is complemented by their ability to access KPMG professionals from across Canada and worldwide as needed. Now, I'm pleased to introduce our keynote speaker for today. Michael Gaylord is a tax partner operating out of the KPMG Kingston office, specializing in tax planning and compliance services for private businesses. Michael has over 10 years of experience working with family business and developing tax plans, bringing in his experience growing up in a family business. He provides tax advisory services that helps clients through all phases of a business life cycle and working with them for their personal estate planning requirements. Michael is currently a board member of Eastern Ontario YMCA and also participates in the annual Polar Plunge in support of Special Olympics Ontario. Please join me in welcoming Michael Gaylord.
Thanks, Jessica. And thanks everyone for attending the call today. As the highlight, the topic is buying and selling a business. And as a tax partner, the buying and selling of a business is really, for me as a tax partner, it's really exciting. It's great to, work with clients to, what they've built up to sell, and, working with planning to show, what is the real value of selling your business, what, after tax cash can you have in your pocket. It's really, exciting working on this type of planning. So I'm happy to be able to, talk about this with you all on the call today. So the learning objectives of the presentation is really to get at a high level, what are some for selling a business? There's share sale, asset sales, and there's a combination, which we would call a hybrid sale approach. Talk about, just the importance of planning when it comes to, selling your business. And, also when buying a business, know when you should involve advisors. These are, large decisions, and having people come in to help work on planning can be very beneficial to you in negotiations and just finding out, what are your objectives and how do we get there? And then at the very end, just because we're approaching, April personal tax season, I've just got a couple items to go over with people to consider, when they're filing their personal tax returns. They're usually just kind of small things, but some things to consider when you are, doing your personal tax return. And with this, the topic was buying and selling a business. It's going to be heavily focused on the selling the business aspect of it, with part of it being related to, buying a business. But some of it is, kind of overlaps whether you're buying or selling. There's considerations that are for each kind of aspect of it. So what we kind of like to say, if you're going to sell your business, we kind of have like a typical timeline that you would generally try to follow to make sure you can kind of maximize the value of your business and, help with negotiation strategies. So you want to start preparing for the sale of your business, generally, 2 to 5 years out before you're actually going to sell, because that helps with, potential planning that you may want to do. People may be aware of the lifetime capital gains exemption. So that allows, if you sell shares of a business, you could utilize your lifetime capital gains exemption to effectively, sell tax-free. The limit for 2022 is it's just over 900,000, and for 2021 it was just below 900,000. And with that lifetime capital gains exemption, there is a 2-year holding period. So if you want to have a family trust involved in the situation, so you can multiply this lifetime capital gains exemption, you need to have the trust hold shares for at least 2 years. So if you try to implement some planning a month before a sale, you're kind of limited as far as what planning could you potentially do. So starting earlier helps with the different options of what you can do. And before you sign a letter of intent, it's always great to analyze your different options. What is the ideal structuring that could be involved for selling the business, so that when you're going to negotiate this LOI, you kind of know how you want to sell your business. So it helps with figuring out what is the best the best way to do it, as opposed to if you jump in and you sign the letter of intent and you're kind of you're down the process and there's different strategies that come into play, you might not be able to implement them to your advantage. So just planning in advance is is a great way to give you the most negotiating power. Once you sign your letter of intent, you get working towards the completion of the sale. So they're implementing the tax plan, working with the lawyers for all the legal agreements, if there's elections that need to be filed, working towards that to get to your sale date. And then there's more than just selling your business. What do you do after that sale date? So there's planning that can be done after. If you're going to have an investment corporation, what are you going to do with those funds? There's planning that you should consider after you sell your business to be forward thinking and what you want to do. So I've kind of mentioned some different reasons as to why to plan, but I've just listed them on the slide here. So tax can be a significant aspect of a deal to the vendor and also to the purchaser. The vendor, selling, if you're able to utilize your lifetime capital gains exemption by selling shares, that's beneficial because you can have a portion of the sales that could be tax exempt. Whereas if you're the purchaser, you may lean more towards buying the assets of a business as opposed to the shares of the business, because you can start to depreciate that cost that you pay for buying the assets. And you don't have to inherit any of the tax liabilities by selling shares. So, the different planning from a tax perspective can impact both, the seller and the purchaser. You want to make sure you align your goals and objectives to the end result. You want to have a solution that's going to be practical and beneficial to both the purchaser and the vendor. So sometimes, initial discussions, maybe you want to sell the shares, the purchaser wants to buy the assets. So you may come into the middle to determine a price, but you want to, make sure it can be beneficial for both parties, because then it's just, I find, easier when you're negotiating and then just kind of getting to the final line of the sale. It's more of a friendly deal. We generally like to, provide solutions for the people selling, to give them the different options so that how should I be selling? What am I looking at from a cash perspective in the interim and in the final, if I distributed everything out? You want to have an efficient deal, and you want to minimize unexpected results. So what I've seen happen in the past is, someone goes to sell their business. Maybe they're selling it for, say, $800,000, and they just, assume that they can have their lifetime capital gains exemption. They didn't bring in advisors. They go complete the deal, but what they ended up actually doing is they sold the assets of the business as opposed to the shares of the business. So what they had thought was going to be a tax-free sale, it was actually a tax sale, because they didn't have their lifetime capital gains exemption because it wasn't structured the way that they thought it was going to be. And just a couple of quotes that we've had. So we've never met a company that had to make an acquisition, but we do meet owners whose only option is to sell. And far too often, circumstances instead of planning dictate that a deal must get done. So if if you're forced to sell your business, you're a little bit handcuffed as far as what planning can you do. So that's what we always say, planning well in advance can be the most beneficial. So I've kind of mentioned different ways of of selling a business. So like asset share sale are the most common. And what we have here just with this landscape is you have your asset sale where, generally the tax rate is say 25% on the interim, but then when you flow the funds out of that corporation, you get to closer to a 29% rate. If you sell shares of your business, your tax rate is generally going to be just under the 27%. And if you have a corporation that then sells shares of the operating company, your corporate tax rate is say 25%. And we have the different kind of hybrid approaches that could also come into play when you're looking to sell your business. So the hybrid, you may have a mix of asset and share sale, where you do kind of more complex planning, where you transfer some of the shares you have into another corporation so you can have a deferral, but also obtaining some of the benefits of the share sale. And then one of the other potential options, if you have a purchaser that is a non-resident or a public company, you can actually get a tax rate that's down to say 13% because of the different tax attributes and mechanisms that would come into play. So the list kind of shows the current tax rates, and then some of these can actually be lowered depending on what is available to the corporation or the individual. So the capital gains exemption, so that's the sale of the shares, you could lower your rate. So that would apply to a share sale, and it could apply to some of the hybrid approaches. And then there's safe income that a corporation may generate, which is effectively after tax retained earnings, which you can pay up to a corporation tax-free generally, so you can achieve a tax deferral. So that could effectively lower some of your interim tax rate. So kind of the basics of the share versus asset sale. So on the asset sale, as the vendor, you're going to want to be looking at, what are the tax attributes of the assets in your business that you're going to be selling, because your corporation may then have capital gains that they pay taxes on, but there also may be recapture. So if you've had assets in your corporation and you've depreciated them over time, when you sell those assets, the depreciation you've taken over time, that comes back into income, and it will be, it's a taxable event to your corporation. And generally, when you do an asset sale, you end up taking the money mostly out via dividends rather than a capital gain. And on the asset side, from the purchaser standpoint, if you're buying the assets, you're going to want to make sure that you're looking at HST, land transfer taxes, because those may apply on those sales. If you're buying the assets and there was, WSIB or different insurance ratings that business had, and you're now buying that business, you want to make sure what is the impact there. Then also, looking at contracts and employees. If you're purchasing the assets of the business, which includes, the goodwill and the employees, you want to make sure you get those employment contracts and everything kind of over it properly. And that's where, there's tax advisors, and then, having the lawyers on your team to help deal with, contracts and employees and everything that would come over. You want to make sure you consider that. And we kind of mentioned, value of the tax shield. So if you're buying the assets of the business, you get to start depreciating what you've paid, so you get that deduction. Whereas if you buy the shares of a business, you inherit the tax base of the assets in that corporation. So you don't really get a bump up for what you've paid to start depreciating. So sometimes in the planning and part of the negotiations is, if you want to do a share sale, you would calculate what is the purchaser losing by buying the shares as opposed to the assets. So you can factor that into, your purchase price and the net present value of those savings. On the share sale side, so the individuals, generally it's just under the 27%, but it could be lower with planning or lifetime capital gains exemption. You don't have to worry about recapture of the assets. It's really just about the shares. And on the purchaser side, they're not going to be getting that depreciation on the underlying business assets. There is potential to bump up some of your tax basis on non-depreciable assets. So if there's land in the corporation that you're buying, you potentially could bump that up. And buying the shares, generally you'd probably save on some indirect taxes that may apply if you were just buying the assets. And the other thing to note as well, if you're the purchaser and you're buying the assets of the business, you're not inheriting the liabilities if you were to buy the shares. And then kind of there's some overlap between those two different options, which gets into the hybrid sale. So there is, planning that can be done where you can, get some benefits of the share sale and also some benefits of the asset sale. And the big thing to, determine what planning works best for you in your situation is just, what are your objectives? Are you planning on reinvesting the proceeds from the sale? Because, if you are planning on reinvesting, you're probably going to favor maximizing your, the cash available at the immediate time of the sale. So getting a tax deferral. So if you can have it in a corporation where you're not paying tax on the immediate total funds, you would probably prefer the deferral. If you're, planning on selling your business and then just using all those funds personally in the near term, you're not really worried about the tax deferral that you can achieve. You're really just focused on, what is the minimal overall tax? Because I'm not leaving money around to invest, I'm taking it out personally. So we like to look at different options. What is the tax that you have to pay today? What is the tax that's going to be paid on future distributions? So that's your deferred tax. And then also looking at, what are the tax implications to the purchaser? So you find out those objectives, what the person that's selling the business, what is their objective? And then you look at different tools that may come into play that you could work with to achieve what you want to obtain. So some of the different tools that are available, there's adjusted cost based. So if you've paid, if you paid for shares or you paid for the assets and you're selling them, that's your adjusted cost base. So, anything that you sell, you're paying above that adjusted cost base. So sometimes in a corporate structure, you may have multiple entities. There may be adjusted cost base in one entity and not the other. So you may look at types of planning so you can utilize that adjusted cost base. As I mentioned, there's lifetime capital gains exemption. So if you have that available, there's tax savings there of just over 900,000. If you're able to multiply that lifetime capital gains exemption via a family trust, you could, shelter quite a bit of the sale. Recently, I had a transaction where with a family trust, we actually were able to utilize 7 lifetime capital gains exemptions. So on say a $10 million sale, there was, about $6 million that could be sheltered by this lifetime capital gains exemption. So you really drive down that tax rate when you have these exemptions available. The safe income, so that's the more of a tax deferral, where if you have safe income available in your corporation, you could pay that out to a holding corporation to invest. So instead of paying, capital gains rate in your corporate dividend, so you're getting a deferral. Ultimately, you don't pay tax on that until you take that out. Excuse me. And then with what we have here is the 84.1 or personal corporate hybrid. That's where it's more complex planning, but you transfer, basically 2/3 of shares into a corporation to allow for a deferral on 2/3 of the gain, so that you can achieve a pretty big tax deferral there. And then also there is what we call 111(4)(e) or asset drop planning, where it's optimal if you have a non-resident purchaser or if it's a public company, where you can do a deferral and get down to a low tax rate on that. So the deferral strategies can be used the deferral strategies are really to get you the cash available if you want to further invest, but ultimately it's just a tax deferral. So when you do take the money out of the corporations, your ultimate tax rate is higher when you pull it out with those deferral strategies. But if you can get a deferral and you can have a higher amount to invest in, then it could offset that potential tax liability further down the road. And you don't have to just pick one tool to use. There's many tools that are available. So with just this example here, if it's if there's a sale for $10 million, your general rate is just under the 27%. So you would have your taxes owing of the 2.67 million. But if you have your lifetime capital gains exemption, that takes away some of the taxes, and that 892, that's effectively the 2021 rate. If you had some safe income available that you could use, that will lower your tax rate. If you're able to do some of the hybrid planning to get some more deferral, you can lower your interim tax rate. So on that, the $10 million sale, really only under 5 million of that would be, say, taxable currently. So you really get a lower tax rate of the 12.2 as opposed to the 26%. So looking at the different tools available and the different planning can help you get a lower interim tax rate. So I've mentioned family trusts earlier, and just what is the structure that you have currently in place, and is there planning, or what should you be done prior to a sale? So in a structure, if you do have a family trust, potential to multiply those lifetime capital gains exemption, you do have to make sure that the trust has held the shares for at least 2 years. So there are different holding periods. And you also want to look at, what is the structure looking like? So in this picture here, where we have, the holdco owns the operating company and your family trust is the owner of the holdco. If a purchaser is coming in and they want to buy opco, in order to use your lifetime capital gains exemption, the family trust actually, would have to sell the shares of holdco. And if there's some assets in there that you need to get out to make sure those shares qualify, you'd have to do planning to make sure you get rid of those redundant assets. And you'd also have to make sure that the purchaser, would be willing to buy your holdco so you could utilize your lifetime capital gains exemption. So having the proper structure in place, well in advance, or planning to get into the proper structure because you're going to be selling your business down the road, is very important, because then it makes the actual transaction a lot easier and more efficient. What we do as tax professionals is come up with the original divestiture model to talk with our clients about, what are your different options? What gives you, interim tax rate, your fully distributed tax rate? What is the cash that you get in your pocket? What are you trying to achieve? So there's all these, different tools that I've kind of mentioned before. So there's the safe income, redundant assets, our cost base, what are our proceeds? But we generally, like to get, what do you think the value of the business is? What are you hoping to sell it for? What are all the different tax attributes of your business? Who are all the shareholders that are going to be selling? Who potentially could be buying? Are they public? Are they non-resident? Are there any, legal or business roadblocks that could come into play? So if you know how you should be selling your business, it really helps to, do the negotiation. So if you have someone that is helping you negotiate a deal, whether it's your lawyer or you bring an outside advisor, if you know how you want to sell it, it helps with, getting the right deal. So with that LOI or the purchase agreement, it helps get you in the right spot, and also outlines, to the purchaser, what the tax benefits are to you, so they could work with you so that it's a win-win for both sides. And this next slide is really just to kind of show from a high-level example on a sale of $10 million where there's one lifetime capital gains exemption available, and that there's safe income available of $2 million, to outline the different plans and the different tax rates that may come into play. So scenario 1 and 2, those are your basic asset or share sale, which generally you would see most of the times is just asset share sale. As you get into scenario 3, 4, 5, and 6, it becomes, it's more complex planning, but you're utilizing, safe income, lifetime capital gains exemption. You're doing some of the hybrid approaches. So it's more technical, it's more complicated, but you'll see there's benefits to it. So if we look at just the cash available immediately subsequent to the sale, so as soon as the sales happened, what cash is available to you or your corporation. So in the asset and the share sale, you get to an interim effective tax rate of around 25%. And as you go into the other scenarios, it starts to drop because of the tax deferral with the different planning tools. So you get down 18%, 12%, 11%, and 13%. So you're having, more cash available to do, immediate reinvesting. So we come down, there's cash available. So on the asset sale, you'd have 2.5 million that would still be in, your corporation, but you'd be able to have $5 million out personally that you could, go and, if you needed to spend it. If you're doing just a straight share sale, all that cash comes out personally of the 7.5 million. So there's none left over, say, for a deferral in a corporation. And then in the other approaches, you see there's a, more funds that are in the corporate entity because of the deferral, and you have, funds that are personally available. So like in the very last scenario with selling to, a public company or a foreign corporation, you get a low interim tax rate, $5 million comes out tax-free, and you're leaving, 3.6 million in the corporation for the deferral. So if people don't need the funds right away, we really like to focus on the cash immediately available and what is that interim effective tax rate. Because if we can get a low interim effective tax rate and you're not needing the money, that's generally what you focus on. But then when you look down to the final line of, fully distributed cash to the individuals, you'll see the tax rate for these more complicated scenarios where we're getting the deferral does go up higher than, if it was just the asset sale or the share sale. So on the share sale, we just know, the rate, say, comes out to 24%, where all these other scenarios where we're getting the tax deferral, you're actually having a higher tax rate because you're bringing out the funds as dividends as opposed to it being a capital gain. So you want to look at, here's all our different options. What am I trying to achieve? What do I need to do with the funds? Should I be more focused on this interim tax rate, or should I look at, the fully distributed cash to the individual's effective tax rate? Because it really just depends, what can you do with that deferral? So that scenario slide that I showed before, it kind of gets more complicated as you go over to the right. And with, our normal planning, there's different options as what you can do, because each tax plan, there's more complexities that go into it, so there's different costs depending on the complexities and the type of planning that you want to do. So, we say, good, better, best, best plus, but there's, all kinds of different things that can come into the different planning. So, doing modeling, doing, different tax technical issues that you want, different research on. So making sure your business qualifies for your lifetime capital gains exemption. There's different criteria that comes into play. How can you do safe income? Is there due diligence? So there's all kinds of different options as what you could do. And really the first part is just understanding, what do you think you're going to be selling your business for? Because if you're going to sell your business for, $900,000, you don't really need to get into the super complicated planning. If you can structure it where you can use your lifetime capital gains exemption and get out tax-free, that will save you taxes. It will save you, professional fees, because you don't need to look into the more complex planning. So you want to make sure you balance what is the potential tax savings, what are the complexities, and what are the professional fees that would go into it. And the other aspect of, selling your business, buying the business, it's not just the tax. Obviously, there's the due diligence that generally comes into play. And kind of having due diligence done in advance, or, being proactive with it, can be very, very helpful. And generally from a tax compliance perspective, people are going to be looking at, have you filed your corporate tax returns? Review the corporate tax returns. Are there any, things that don't look right? Are all information returns filed? GST, foreign reporting, has that all been filed? You want to make sure to look at that. If there's tax positions, so if you're buying an entity, if you can get any restructuring memos, or if there's been, safe income, if you're paying it out, you want to make sure you're comfortable with those tax positions. And also just on tax policies, you want to see if there's management fees in a corporate group, or there's some transfer pricing. You want to make sure you're comfortable with, what's been documented. What are we, taking over if we're buying this shares of the company, to make sure things are documented to avoid some potential risk. And So this next slide is just, some of the common trends and risks that may come up during due diligence procedures. So deficiencies in process, that's where you're looking at, tax compliance, sales taxes, intercompany. Has everything been filed? Are there potential areas that, need to get caught up in filing, or, that there's a risk a CRA could come and, say this wasn't filed, nothing statute barred. Cross-border matters we see as a big one when you do have, if you have, say, some US operations, if there's intercompany transactions or there's foreign affiliates, you want to make sure that, that's not going to be a great risk. So if there's, intercompany transactions across the border, there's the T106 transaction forms that would need to be filed. So you want to make sure that's not a risk area. Shareholder and employee matters. So just, looking at, what is the payroll? Are there any shareholder issues? If there are some shareholder issues, you may want to get them cleaned up before you complete the transaction. Significant transactions. So if you're, if you're purchasing a business, you want to look at some, large dollar pre-closing transactions, see what's there. Is that going to impact you? Make sure that everyone is on side with, what the planning is going to be for closing, so that nothing comes out of there. And the one really big thing we're obviously seeing now on transactions is just the impact of COVID-19. So a lot of businesses were able to receive some, benefits from COVID-19 with different wage subsidies or other programs. And the CRA is now, starting to do some audits of the, the eligibility. So if you're buying a business, you want to make sure that you're comfortable that that business was eligible for those COVID relief benefits. Because if you buy the shares and the CRA comes in and, says, no, you weren't eligible, you owe this money back, you want to make sure that at least you're comfortable, or it gets factored into, the share purchase agreement, if the CRA does come back and adjust for that. So there's another slide just on the due diligence, where in recent years, we've seen a significant shift towards pre-sale vendor due diligence and away from the conventional due diligence. So conventional due diligence is, you kind of get into the transaction, and the purchaser's advisors are really leading that process and kind of asking all the questions and kind of getting all of their information, which, has a lot of expenses and time that go into that. Where sometimes now we're seeing the pre-sale vendor. So if you're going to be selling your company, you're kind of going in and getting all of that, due diligence is ready, front loaded to give to the purchaser, so they can easily come in, flush out, any issues that they see in advance, gives more confidence in the deal and kind of maintains that momentum going forward. And it hopefully, eliminates any, one-sided deal structuring or any, issues that you didn't think of, that if it comes up later in the deal, it may impact your negotiating power. So you want to kind of get in front of all of that well in advance. And this is on the due diligence, where the lawyers, having a lawyer that has the experience in dealing with these types of transaction is very important, because they'll be able to go through, contracts and help you come up with, a lot of the lists that should be, shown to the other side. So most of what I've talked about is, selling your business. But, if you're buying a business, you want to make sure you're looking at, how is that the purchase of that business going to benefit you? So how are you going to maintain the revenue and the cash flows of that business? So making sure you're comfortable with the balance sheet, that it's strong, you're doing your due diligence. But also a big part is, how does the business run? Is it run by key management? Is it key employees? How are you going to make sure that you're keeping those employees and management team, incentivized to keep working, in the business, and, to help you grow the business that you're purchasing? What is your strategic plan when you buy the business? Because, you could come in and buy the business where it's, the management team, it's really, the management team runs it. So as long as you're keeping them on the team and they're incentivized, you may be able to have like a hands-off approach. But if you're looking into the business where if the owner is going to be stepping away, how hands-on are you going to be? Who do you need to have on your team to make sure that it's a successful transition into that business? Okay. So I mentioned, we're like, I'm a tax person, so we like to do the tax planning. Like this is kind of the fun part where you could do, you work with an Excel, all the different tools you have at your disposal to see, here's the different tax rates that you can do. We like, we work with our clients all the time, but if if you have your accountant or your advisor and who doesn't have, the experience in selling the business, don't hesitate to reach out to advisors, accountants, tax accountants, your lawyers who have experience, working with these deals, because we can work, you work with your current advisors that you have to really get your ultimate benefit to you as the, the person selling their business or buying the business. And bringing, someone in that has the experience with the negotiations, so that if, you have a plan and then you have someone that is going to help you negotiate the deal, can really get into some of the finer points as to, when you're dealing with the other side, you want to have a full team at your disposal to get the best benefit to you. On a recent transaction that we had, there was, a client, they were going to be selling their business, and the purchaser had come in and, was getting a lot of, questions. They had their professional advisors that were really working on, getting all this information, coming up with really kind of dictating the sale. And then we came in and brought in, a deal team that started working on the negotiations and really got the client, a fair price for what they had. Where if they didn't have the advisor come in to help negotiate, I think the price probably would have ended up being lower than what they actually got. And I'm just going to quickly talk on, so Bill C2A, which came out last year, was to help with intergenerational transfers, which really impacts, selling the business, because, you're transferring it to the next generation. Where before Bill C208, you were really actually better off to sell it to a non-arm's length party as opposed to transferring it to the next generation. Because when you transferred it to the next generation, you wouldn't actually be able to get your lifetime capital gains exemption or really utilize capital gains rates. Where if you sold it to an arm's length party, you could get capital gains rates. You'd get a better overall tax rate. So the Bill C208, so 84.1, kind of more technical, that came out, just makes it easier and gives more opportunity for those intergenerational transfers to achieve kind of more tax efficient transfer. And there's also rules that came out that makes it easier for, if you do have a family business and there's siblings, if you need to split up that business, it kind of gives you more tools to, actually split up that business in a tax efficient way. And with the Bill C208, what really it's intended is for, genuine transfers of the business to the next generation. So finance is still going to be coming out with more kind of guidance, because they do have some issues with kind of the current wording of the rules, but they want to make sure that it's, a genuine transfer. So if you're transferring it to the next generation, what is the timeline of, actual control? Are the next generation actually going to be involved in the business? They want to avoid, just a paper transaction. So if you're not going to transfer to the next generation, but you do it basically on paper to achieve a better tax rate, finance is kind of, looking at that they don't really like that. So there's going to be more that coming out, but at the end of the day, it does give more tools for transferring to the next generation, which is very welcome news. So just this last little bit, I'm just going to kind of talk about some personal tax planning that you could do when you're filing your personal tax return for 2021. So the first thing is RSP contributions versus the actual deductions. So for the most part, people will see, I have a RSP limit of say $10,000. So I know I can put $10,000 into my RSP. And then generally the default would be just to deduct that $10,000 because it would offset against your taxable income in the year. But if you're looking, if you're forward looking and you see that, okay, my current tax rate right now is say at 20%. So if I made that contribution, and if I take that full deduction of the $10,000, I get it at a deduction at the 20% marginal tax rate. So if next year, maybe you're you've switched jobs, or you've got a promotion, or you're going to be making more money next year, so that your taxable income is going to be in a higher tax rate. You could not take the deduction for that RSP contribution that you made in the year and actually save it for next year to deduct when you're at a higher tax rate. So if your income went up and you're in an income bracket where you were at a 40% rate, getting the $10,000 deduction at a 40% tax rate as opposed to the 20% tax rate, you get kind of more bang for your buck, I would say. But the key there is just, what is your cash flow needs now? Is it better just to take that deduction, get the refund now, or do you save it to the future year? But it's just something to consider, because sometimes I think the default is just, deduct whatever you contributed, but it's something to consider. And then for 2022 tax installments, so the tax installments are based on what the prior year taxes payable, what you had owing in the prior year. So you may make a March 15th, 2022 tax payment, which is kind of based on your 2020 tax year. And then once you complete your 2021 personal tax return, if your installment requirements are actually less, then consider adjusting what your June 15th installment payment would be, because that will just help with kind of cash flow requirements. The other one is donations. So generally with donations, there's a 5-year period that you can claim. So if you haven't claimed donations from 2018, you could still claim them on your 2021 tax return. And with donations, when you claim them that are over $200, there's actually an enhanced donation credit. So if you make $150 of donations every year, you may actually want to consider holding those together and claiming them all in 1 year, because as soon as you get over that $200 total, you're going to get an enhanced donation tax credit. So just something to consider, when you're claiming your donations, you could get a better tax credit if you kind of pool those together and save them for 1 year. Medical expenses. So most people will default to just claiming their medical expenses for the calendar year, but you can claim any 12-month period that ends in, say, 2021. So if your total expenses for 2020, weren't enough to get a medical expense claim on your 2020 return, but there was a large expense in December of 2020, and then you had some expenses earlier in 2021, you could actually claim the period, December 1st, 2020 to November 30th, 2021, to make sure you actually get the best benefit for your medical expenses. So just something to consider if you do have large medical expenses, that doesn't have to necessarily be that calendar year. It can just be any 12-month period ending in the year. Sale of principal residence reporting, that's just a reminder that if you do sell your principal residence, you do need to report it on tax returns. That's kind of been out for the last couple of years, but just a reminder. And then the last one I have here is just CCA. So that's basically your tax depreciation on rental properties. You want to make sure you consider your income level and what the benefit of claiming that CCA is versus, if you're going to sell in the future, what your taxes may be. So with the rental property, you buy the building, and then you start to take a tax depreciation where you get that, the benefit of that depreciation each year. But if you say you're in a lower income tax bracket, like say the 20%, and you claim the CCA, you're getting that benefit at the 20% rate. And if you had this rental property for a while and you've been claiming that CCA, that's fine, you're getting the deduction. But then if you go to sell your rental property, and the real estate market it seems to keep going up and up, you're most likely going to have a large capital gain. And when you have that capital gain, you'd also have recapture. So all of the deductions you've taken in the previous years, that will all come back into your income when you sell the property. And since you'll have a large gain and all this recapture, you're probably going to be in a lot of a higher income tax bracket where all of that recapture could be taxed at the top rate of 50%, where you were only actually getting the benefit of that deduction at a 20% rate. So it could just kind of be surprising when you sell a rental property and the actual taxes that come into play on it. So just something to consider when you do have a rental property, what is that benefit of the CCA? So that's it for the presentation. if you have any questions, please feel free to ask them. Thank you, for your time with the tax planning on sale of a business. It's fun for me. So I know I kind of jump around sometimes when I'm talking about it, but it is, as a tax person, that's kind of the fun tax stuff, is working with all those tools and, helping your client to show them, the actual dollars that can go into their pocket. So thank you, everyone.
Wonderful. Well, thank you so much for that, Michael. That was a fantastic presentation. So we'll now start the Q&A session of today's recording. If anyone has a question, you can either enter it into the chat, you can use the raise your hand function, or you can simply unmute yourself, whichever is your preference. But to start us off, we do have one question from Cam. And Cam is asking, can you give some information about what is included in a letter of intent?
So with the letter of intent, it's really just more of it's not the full details of the structure. It's more of just, here's a letter. I'm going to be, the general guidelines of, I'm going to buy your business for $10 million. There's going to be some adjustments, but it doesn't get into like all the details. It's more of just kind of the high level. Here's the letter of intent. Sometimes it may also include, we're going to be able to start looking at some information. And you can have them where they're non-binding or they're binding. But then you probably also want to get some, documents signed where if they sign a letter of intent, they can't disclose everything. But it's really the start. So in the letter of intent, if it comes in and say, we're going to buy the shares of your business, and you sign it, then not necessarily you're locked into that structure, but it's kind of harder to get out of that if you've signed a document to kind of say, this is generally what we're going to do. So generally they're non-binding. It's more of just the general framework.
Okay, that helps. Thank you. I just was curious if there would be sort of different stages to it. Would you have just a very broad open-ended one to start with, and then maybe a little later one that's more serious, or is there only one and then it just goes straight to the sale documents?
So that there probably could be multiple ones. The lawyers would probably know that answer best, but generally, you work towards the letter of intent. And lots of times that may go back and forth a bit too, before say it's signed. And if it's binding, then generally, that's the letter of intent, and then you work towards the purchase agreement documents. But that's kind of more of just like the general framework.
Great, thank you very much. Nice presentation, appreciate it.
Oh, thank you.
Wonderful. Well, thank you for that question, Cam. Just scanning the audience here. I don't see any hands up. Oh, actually, we just got a question in the chat here from Stacy. Thank you, Stacy. So from a broker perspective, typically we start with an LOI, then we move to a binding agreement of purchase and sale as reviewed by the lawyers. Oh, sorry. So this is not a question. She's just contributing there.
And one thing I'll add to, so at the very start, we kind of talked about, the timelines you work towards your sale and the tax deferral. And that's where you want to get, the investment advisors where, if you don't have them already, you work with your investment advisors so that, you have your corporation maybe becomes an investment corporation. So then you can work with your investment advisors as to, what are you going to do with those funds after the sale. So it's really important to get, a full team so that you can make it the most tax efficient deal at the time, and then also going forward.
Perfect. Well, thank you for that, Stacy and Michael. I will just say, I understand this, presentation is being recorded. So if there are any specific questions that you would prefer to ask offline in a more private setting, feel free to send me an email and be happy to pass that on to Mike and his team. But if there is anything else you'd like to ask, we've got a couple minutes left. I'll just scan the audience one last time here. Okay, I think you must have covered it all.
Perfect. Well, thanks, Jessica and Karen, for letting us, sponsor this, and also just letting us do the presentation. It was great.
Oh, absolutely. Well, thank you again. And thanks to everyone for joining us today. We hope to see you all again on March 10th for our annual Powering Success event. And of course, I would like to say again, thank you to Michael and the team at KPMG, not only for today's presentation, but for their continued support of the series. We so greatly appreciate it. So thank you, everyone, and enjoy the rest of your day.